One thing I just said before I started recording is stop thinking about what it takes for you to change your mind. Start thinking of what it takes for you to read and watch the market change its mind. You don't have as much personal connection. When the market change its mind is what you're looking for. If you always think it's your mind and your opinion being changed, it's going to be harder to change it. You're going to be stubborn with it, and you're going to be afraid of being wrong. Now, in this recording, we had a big long position open up on the open. Generally, that drives bias in a direction. So I was a little bit bullish coming in, and that's okay. When did I change my mind? As soon as this happened. We started going down, but we started going down and it was trapping a lot of people who are long. Today we open up 30 higher in the S&Ps, 300 higher in the Dow from over the weekend. What you get are generally everybody and their cousins bullish, and that's fine. And it's okay to be bullish, but it's not okay to not spot a reversal when you got everybody in that camp. You have a lot of people who are stuck short from over the weekend. You also have a lot of people bullish coming in. So you watch the open. And if there's a moment where you might have a reversal, you start to get everybody stuck who's bullish coming in to the session. So we had not just a big move lower right after the open as it tried to go higher. Bam, it comes off. But you get a bunch of longs getting picked off, which means they get long, take heat, get long, take heat, get long, take heat. If there's anything you learn from these videos, it's after you're long, you are a seller. So now, let me speed it up. You could see us come in. Let me rewind it. We get through those shorts and we come in, we get all those longs. You've seen my cursor in real time talk about that and say, this is a bit of a reversal. You don't have to necessarily go bullish to bearish, but don't be bullish. And then you should have these shorts, if they go away, more downside. And if you get more longs to come in here, more downside. And if they don't stop here at 78, 79, more downside. But guess what happens? We stop there, hesitate, chop sideways, more longs come in. You see my arrow going to it, more downside pressure. And then they crack it with like a 2,000 or 500 lot sell and right back up to where these shorts get in, more longs come in, more downside pressure. And every time you see shorts sneak in, it's a temporary bottom. They sneak in right here at 74 quarter. Let me rewind it. They sneak in, little Johnny gets short, little Johnny takes heat, little Johnny gets stopped out, goes back to the scene of the crime. Now, what's important is as soon as we built up a long position right in here, just has a better chance of going down. So look at all this. That is a moment where you probably got more downside pressure, and then it doesn't become a good guess. Look at all these longs coming in. Doesn't become a good guess, it becomes a probability. Meteorologists can't be surprised when they say, hey, tonight it's going to rain. And then it rains. Oh, surprise, that happened. You have to be you have to start having probabilities attached to your opinions because you're watching the market's opinion and people who are stuck long, stuck short. So like I said, either you're in our group or you're on our charts, and think about how difficult it would be once you're used to now reading the market this way if this was taken away.